This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Welcome to the deep dive. Today, we're really plunging into a legal landscape that, well, it feels like it's constantly shifting. Tax rules aren't just evolving, they're fundamentally transforming. Our focus, it's the European Union's big push for tax transparency and against avoidance. We'll be looking closely at what this means for the global fund industry, especially, right here in Luxembourg. We're talking about two key pieces of legislation: the Anti-Tax Avoidance Directive, ATAD, and the Directive on Administrative Cooperation, DAC. We've got some great source material, and our mission today is to pull out the most crucial insights for you. We want to make sure you're genuinely well-informed on this, pretty vital area, so get ready for some, hopefully, moments, like understanding why a major EU tax proposal suddenly collapsed just recently, or how just, a single paragraph in a law can completely reshape how funds are structured. We're here to guide you through this complex terrain. Clear explanations, useful details. All right, let's unpack this. There's talk of a strategic shift in the EU's approach. For years, they've pushed for more openness, right? But the sources suggest something new is happening. What's really driving this evolution?
Yeah, that's a great point. If you connect the dots, it really does look like a pivot. They seem to be moving away from, very rigid prescriptive rules towards enhanced information exchange.
Sure.
I think the dramatic collapse of the ATAD 3 unshelled proposal, which ECOFIN confirmed just last month, mid-2025, really signals this.
Right. ECOFIN report 996025.
Exactly. It seems they're realizing that maybe a uniform hammer isn't the best tool across such a diverse union. Maybe the scalpel of transparency, as you might call it, is more effective now.
Okay, so what does this actually mean for us, for you listening, especially if you're in the financial sector here? Is it like a sigh of relief or just the goalposts moving?
Well, for the Luxembourg fund industry, I'd say the main battlegrounds, they remain pretty clear. It's the operational headaches of ATAD 2's anti-hybrid rules. They were formidable. And then it's strategically getting ready for the next big data wave under DAC. It's not just about ticking compliance boxes anymore. It's really about foresight, about future-proofing your structures.
Okay, let's start with ATAD then, the Anti-Tax Avoidance Directive. Our sources frame this as the EU's direct answer to the OECD's BEPS project, Base Erosion and Profit Shifting. ATAD set minimum standards. Let's begin with ATAD 1, which Luxembourg brought into law with the Loi du 21 December 2018, effective mostly from January 1st, 2019.
That's right. That law brought in several key things. First up, the interest limitation rule. It's in Article 168 times of the Luxembourg Income Tax Law, the LIR. It basically tackles earning stripping using excessive debt to reduce taxable profits.
How does it limit that?
It caps the deductibility of net borrowing costs. The law calls them excess borrowing costs, sous-coût d'emprunt, at the higher of two limits. Either 30% of EBITDA, that's earnings before interest, tax, depreciation, amortization, or a flat 3 million euros.
And here's a really crucial point for the financial sector, right? Luxembourg's version has a key exemption.
Yes, absolutely pivotal. An exemption for financial undertakings. This covers banks, insurance companies, and importantly, many types of investment funds, UCIs, AIFs. It was a big deal for maintaining their operational model. Oh, and there was also that grandfathering clause for loans from before June 17th, 2016, provided they weren't modified.
Okay, what else did ATAD 1 bring?
Next were the Controlled Foreign Company rules, the CFC rules, Article 164 LIR. This is pretty new for Luxembourg tax law. It's designed to stop profits being shifted to low-tax countries.
How does it define a CFC?
Two tests. A controlled test does a Luxembourg taxpayer hold over 50%, and an effective tax rate test does the foreign entity pay less than half the tax it would in Luxembourg. If yes to both, it's potentially a CFC.
And how did Luxembourg apply this?
Luxembourg chose what's called Option B. This means the rules only bite on non-distributed income that comes from non-genuine arrangements, set up mainly to get a tax advantage. An arrangement is seen as non-genuine if, basically, the CFC wouldn't hold the assets or take the risks without the Luxembourg parent doing the important work, the significant people functions.
Are there ways around it for smaller operations?
Yes, there are de minimis exemptions. If the CFC's accounting profits are under 750,000 euros, or if its profits aren't more than 10% of its operating costs, the rules generally don't apply. helps avoid hitting legitimate small businesses.
Okay, beyond specific rules, ATAD also aimed for a general safety net, didn't it? The GAR.
Exactly, the General Anti-Abuse Rule. It's in Section 6 of the Adapted Tax Law. Luxembourg already had a GAR, but ATAD brought it in line with the EU text. Abuse happens if an arrangement isn't genuine, meaning it lacks valid commercial reasons that reflect economic reality, and one of the main aims is getting a tax advantage. It codified principles already floating around in case law.
Right, and the last piece of ATAD 1.
Exit taxation. The rules changed for companies moving assets or their tax residence out of Luxembourg. From January 1st, 2020, any unrealized gains are taxed immediately. However, there's an option to pay in 5 yearly installments if the move is to another EU or European Economic Area country.
Okay, so ATAD 1 laid the groundwork. Then came ATAD 2 via the Loi du 20 December 2019. This seems to have really broadened the scope, especially for Luxembourg's fund structures, right? Bringing third countries into the anti-hybrid rules.
Absolutely. ATAD 2 expanded things significantly. The anti-hybrid mismatch rules, now in Article 168 or LIR, are, well, probably the most complex part. They're designed to stop tax advantages that arise because different countries treat the same financial instrument or entity differently.
Leading to things like double deductions.
Exactly. Double deduction, deducting the same expense in 2 places. Or deduction without inclusion, getting a tax deduction in one country for a payment that isn't taxed as income in the other. These rules target mismatches between associated enterprises.
Associated.
Generally, it means a 50% link, direct or indirect. But it drops to 25% for hybrid financial instruments specifically. And there's an acting together concept, too, to catch situations where multiple parties coordinate.
Okay, now let's talk about something really critical for Luxembourg funds. The reverse hybrid mismatch rules. Article 168 Quater LIR, effective from the 2022 tax year. This sounds potentially disruptive.
It certainly had the potential. It targets Luxembourg partnerships. Think of the popular SCSP, the Société or Commandite Spéciale. Luxembourg sees these as tax transparent. But what if the investors in, say, the US or UK see it as opaque, as a taxable entity?
So a mismatch in perception.
Precisely. If associated non-resident investors who see the partnership as opaque collectively hold 50% or more of it, then the Luxembourg partnership itself suddenly becomes liable for corporate income tax on the income attributed to those investors that would otherwise go untaxed.
Wow, okay. That sounds like it could have really hampered the use of SCSPs. How did Luxembourg handle that? Did they soften the blow?
They did. And this is where Luxembourg's knack for pragmatic transposition comes in. They introduced 2 really important safe harbors. First, the Collective Investment Vehicle Exemption, the CIV exemption.
What does that cover?
It explicitly carves out investment funds that are widely held, diversified, and subject to investor protection rules. Think regulated funds like SIFs, specialized investment funds, and RAIFs, reserved alternative investment funds, and certain qualifying AIFs. This preserved their tax neutrality, which was crucial.
And the second, safe harbor.
The acting together de minimis rule. This creates a presumption, rebuttable, but still useful, that an investor holding less than 10% in a fund isn't acting together with other investors for the purposes of that 50% reverse hybrid threshold. It significantly cuts down the admin burden for widely held funds. Very smart.
That does sound pragmatic. Okay, let's shift to the big news from last month, June 2025. ATAD 3, the unshell proposal, officially dropped. It was meant to tackle shell companies by setting minimum substance requirements across the EU. How was it meant to work, and why did it fall apart?
Well, the proposal had this multi-stage filter. First, these gateway criteria, things like passive income levels, cross-border activity, outsourcing management. If you trip those gateways, you were deemed at risk.
And then
You'd have to report on substance indicators. Do you have your own premises, an active EU bank account, qualified local directors, or enough local employees? If you failed those, you'd be presumed a shell entity, facing nasty tax consequences like losing treaty benefits.
So why couldn't the member states agree? The ECOFIN report 996025 mentioned unanimous consensus couldn't be reached.
The sticking points seem to be concerns about the sheer administrative burden, the rigidity of the rules, and the risk of hitting legitimate structures unintentionally. The political will just wasn't there for that specific approach. Instead, the consensus shifted towards potentially amending DC-6 to tackle substance.
Interesting. So a shift from prescriptive rules to using transparency as the tool.
Exactly. It's a move towards a more risk-based approach.
Yeah.
Use information exchange under DO to flag potential shells rather than trying to define substance rigidly for everyone. It's quite a profound evolution in thinking, actually.
Okay, let's pivot alongside the EU then, towards the DAC directives, the Directive on Administrative Cooperation. These aren't about what taxes do, but ensuring tax authorities share information, starting with DA6, brought in by the Loi de 25 Mars 2020.
Yes, DDA6 was a game changer. It really aimed to pull potentially aggressive tax planning out into the open. The law puts the reporting onus mainly on intermediaries.
Who counts as an intermediary?
There are primary ones, those who design, market, or organize the arrangement, and secondary ones, those who provide aid, assistance, or advice related to it. If there's no intermediary obliged to report, because they're outside the EU or have legal privilege, then the obligation falls back onto the relevant taxpayer.
And what triggers the reporting?
It applies to reportable cross-border arrangements. An arrangement is reportable if it crosses borders and has at least one of the specific hallmarks listed in the law, which suggests potential tax avoidance.
Right, the hallmarks. There are different categories, aren't there?
5 categories, yes. Category A is generic hallmarks, and they need to meet the main benefit test. The MBT, meaning a main driver, was the tax advantage. Think confidentiality clauses tied to the tax benefit or fees contingent on the tax saving.
Okay. Category B.
Specific hallmarks also linked to the MBT. Examples include acquiring a loss-making company to use its losses or schemes converting income into lower taxed capital.
Category C.
These are specific to cross-border transactions. Some need the MBT, some don't. An example is making deductible payments to an associated company in a zero-tax jurisdiction.
And D.
Category D hallmarks aren't subject to the MBT. They focus on arrangements designed to circumvent automatic information exchange, like the Common Reporting Standard, CRS, or to obscure beneficial ownership. Category E, also not needing the MBT, relates to transfer pricing things like using unilateral safe harbors or transferring hard-to-value intangible assets where valuation is tricky.
Now, Luxembourg has specific rules around legal professional privilege, doesn't it? How does that interact with DDA6?
It does. The Luxembourg law gives an explicit exemption from reporting for lawyers, chartered accountants, experts, comptables, and statutory auditors, réviseurs d'entreprise, if reporting would breach their professional secrecy rules.
But they can't just stay silent, right?
No, and this is a key detail. They must notify any other intermediary involved who doesn't have privilege, or if there isn't one, the taxpayer themselves, informing them of their reporting obligation. This notification has to happen within 10 days, so privilege doesn't break the reporting chain entirely.
Got it. Okay, moving swiftly on. DT7, what did that add?
DAC7, based on Directive EU 2024-14, brought the digital economy firmly into the automatic exchange net. It became effective from January 1st, 2023, based on Parliamentary Draft Law 8-29.
What does it require?
Digital platform operators, think marketplaces, app stores, accommodation sharing sites, now have to collect information on the sellers using their platform, verify it, and report the income these sellers earn. Covers sales of goods, personal services, and rentals of property or transport. The first data exchange for the year 2023 happened earlier this year, 2024. The deadline was actually pushed back slightly to February 19th, 2024.
Okay, that brings us right up to the next big thing. DC8, based on Directive EU 2023-2226. This looks like the next major compliance hurdle, with rules kicking in from January 1st, 2026.
That's right. DC8 expands reporting significantly, primarily in 2 areas. First, it brings in the OECD's Crypto Asset Reporting Framework, or CARF.
What does that mean in practice?
It means crypto asset service providers, CASPs, so exchanges, wallet providers, etc., will have to collect data on their users and report transactions involving crypto assets. It's quite broad, covers assets under the new MiCA regulation, stablecoins, even certain NFTs, non-fungible tokens.
And the second main area for DSE?
It amends the existing Common Reporting Standard, the CRS. It explicitly brings e-money and central bank digital currencies into scope. This means e-money institutions will now be classed as reporting financial institutions under CRS, with all the due diligence and reporting that entails.
Any other key changes in DC8 we should know about?
Yes, a couple of others. It mandates automatic exchange of information on advanced cross-border tax rulings given to high-net-worth individuals, specifically for transactions over 1.5 million euros. It also refines DA6 slightly, clarifying the waiver for legal professional privilege, essentially formalizing what Luxembourg already did. And there's a big emphasis on collecting and using tax identification numbers, TINs, to help tax authorities match information correctly.
Okay, wow. That's a lot of directives, a lot of rules. Let's bring this down to earth. What does this all mean for you, listening, working day to day in the Luxembourg fund sector? This isn't just theory. It means new processes, more paperwork, different responsibilities. Who exactly feels the impact?
Well, fund managers and administrators are right in the thick of it, especially with D-Day 6. AIFMs, alternative investment fund managers, and central admins often fit the definition of primary or secondary intermediaries. So they have direct reporting duties. Think about a real estate fund manager structuring acquisitions. They're pretty clearly intermediaries.
And investors, they're not reporting usually, but they're impacted.
Hugely impacted, particularly by ATAD 2, that reverse hybrid rule. Its application depends entirely on how investors are taxed back home. So investor onboarding isn't just KYC anymore, it's serious tax due diligence. And yes, under DT6, if no intermediary reports, the buck stops with the relevant taxpayer, which could be the fund itself or maybe a holding company.
What about the professional service providers, lawyers, auditors, accountants?
As we said, under DC6 in Luxembourg, they have privilege, so they don't report directly. But they do have that crucial duty to notify others. And remember, the definition of a secondary intermediary providing aid, assistance, or advice is broad. It could potentially pull in others like depositaries, transfer agents, maybe even domiciliation agents, depending on exactly what they do on a deal.
All this change must mean core legal documents look pretty different now. They're not just commercial agreements anymore, are they? They're risk management tools.
Absolutely. Take the PPM, the private placement memorandum, or the LPA, the limited partnership agreement. They now need much stronger risk factor sections. You have to clearly disclose the potential impact of ATAD 2's anti-hybrid rules, especially that reverse hybrid risk, the chance the fund itself could become liable for corporate tax. DS6 reporting potential needs mentioning too.
And subscription documents, side letters.
Critically important now. Subscription docs routinely demand detailed statements from investors about their tax status and how they classify the fund in their home country. Tax questionnaires are common. Side letters might contain specific clauses about sharing tax info or handling unique investor situations. Negotiating these tax points has become a really key part of the fundraising process.
Have you seen this really force fund managers to completely rethink how they bring investors on board?
Oh, definitely. The depth of due diligence required on investors has ramped up significantly. It's moved way beyond standard KYC into detailed tax classification checks.
And staying on top of the deadlines is obviously crucial. Let's quickly recap the key dates.
Sure. ATAD 1 mostly kicked in January 1st, 2019, exit tax from January 1st, 2020. ATAD 2's main anti-hybrid rules started January 1st, 2020, but the really key reverse hybrid rules applied from January 1st, 2022.
DC6.
Reporting started July 1st, 2020. Remember that look-back period for older arrangements. That needed reporting by February 28th, 2021. And new arrangements trigger a tight 30-day reporting clock. Rules applied from January 1st, 2023. First reports for 2023 data were due early 2024, technically February 19th.
And DAC 8 is the next big one. Transposition by end of 2025, rules apply from January 1st, 2026.
That's the timeline. And navigating all this means compliance has become, well, much more strategic. It involves serious negotiation, real financial outlay, and valuing expert advice differently.
You mentioned negotiation. How has that changed in fund docs?
It's become much more focused on tax risk allocation. With the ATAD 2 reverse hybrid rule, getting accurate, certified info from investors about their tax status is paramount for the manager to monitor that 50% threshold. So LPAs and subscription docs now have really robust clauses requiring investors to provide that info.
And if they get it wrong?
That's where indemnification clauses come in. The negotiation often centers on making investors liable if their incorrect information causes the fund to incur corporate tax. This isn't just standard legal text anymore. It's a vital shield against tax leakage that could hit returns for everyone.
Let's talk cost. This regulatory overhaul clearly isn't cheap. What are the true costs of compliance? Maybe beyond just the obvious legal bills.
Well, the direct costs are significant, yes. Legal and tax advisory fees have definitely increased.
Yeah.
Then there's investment in RegTech, specialized software for managing DC6, CRS, and soon DC8 reporting. And don't forget VAT on those services, currently 17% here.
What about the less obvious indirect costs?
Those are substantial too. Think about the internal time and effort, developing governance frameworks, drafting detailed policies, setting up DC6 decision trees, training staff across multiple teams, legal, compliance, operations. It requires clear roles and responsibilities. It's a significant drain on skilled people's time.
And the stakes if you get it wrong. Penalties. Reputational damage.
Absolutely. The Luxembourg DC6 law has penalties up to 250,000 euros for each reporting failure. That's serious money. But beyond fines, non-compliance carries huge reputational risk. It can really hurt fundraising efforts, especially now with the growing focus on ESG, environmental, social, and governance factors. Investors want partners with strong governance.
So the cost of expert advice is really an investment.
Exactly. You can almost see it as an insurance premium. Good advice helps you build a defensible position if the tax authorities, Administration de Contribution Directe, the ACD, come knocking. It mitigates those potentially severe financial and reputational risks like that €250,000 penalty, or worse, the fund suddenly facing corporate tax because of an ATAD 2 issue.
Okay, looking ahead then, the legislative train keeps rolling. What's next on the horizon? What should people be actively preparing for now?
The immediate big one is definitely DC8. Getting ready for that January 1st, 2026 start date for crypto and e-money reporting is crucial. But looking slightly further out, I think the ghost of ATAD 3 is still around. With the unshelled directive itself shelved, the political energy seems geared towards using DC6 to tackle substance issues instead. So we should probably anticipate discussions at the EU level about adding new hallmarks to DC6, specifically targeting lack of substance. They might achieve the unshelled goal through transparency reporting after all.
It really sounds like constant change. Amidst all this complexity, how does Luxembourg manage to stay, attractive? What keeps it a stable hub?
It's a great question and maybe slightly counterintuitive, but this complexity can actually play to Luxembourg's strengths. I see three key assets. First, that pragmatic transposition we talked about.
Like the ATAD 2 safe harbors.
Exactly. Where EU directives allow flexibility, Luxembourg has historically shown a knack for using it sensibly, providing workable solutions like the CIV exemption or the acting together de minimis rule. That protects legitimate business.
Okay, asset number 2.
The ecosystem of expertise. There's just an incredible concentration of skilled, legal, tax, and administrative professionals here. Law firms, advisors, fund admins, plus a sophisticated regulator in the CSSF, Commission de Surveillance du Secteur Financier. It's like a critical national infrastructure supporting the financial sector.
And the third asset?
I'd say it's the predictable and transparent framework. By consistently adopting all the major international standards, FACSA, CRS, ATAD, all the DACs, Luxembourg has actually built one of the most predictable and, frankly, stable regulatory environments you can find globally. For institutional investors who prize stability and good governance, that reliability is perhaps its most valuable offering. It keeps it a top domicile choice.
Okay, as we wrap up this deep dive, let's quickly recap the main takeaways, the key things you should remember from today.
Sure. First big one. ATAD 3 Unshell is dead in its original form. The EU focus has shifted. Expect substance issues to be tackled via transparency, likely through changes to dossiers down the line.
Second key point.
ATAD 2's reverse hybrid rule. It remains probably the single biggest compliance headache for Luxembourg funds. Getting investor due diligence right, classifying them correctly, and having solid documentation is absolutely vital for protecting that tax neutrality.
And third.
Get ready for DC8. The reporting that widens significantly from 2026 to include crypto assets and e-money. Don't wait until late 2025 to figure out how this impacts your systems and processes. Start looking at it now.
So yes, the tax regulation landscape is definitely complex, constantly moving, a real labyrinth sometimes. But hopefully with a clearer understanding of the rules, a strategic mindset towards compliance, and crucially access to the right expertise, you can navigate this path confidently. Maybe even turn these challenges into opportunities for building stronger, more resilient fund structures. This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.